Hello. Perfect. Just give everyone a quick second there to jump on. Before we dive in, hey guys, my name is Thomas, co-founder here at Store Hero. Really looking forward to an exciting session today. We've got an amazing workshop around profit first forecasting, stop guessing and start planning for profit in 2026. Really topical subject, I suppose, kicking off the year. We've done loads and loads of forecasting sessions with many of our clients. Many of you I can see are already on the call today, so really looking forward to getting into this one. Before we dive in, I'd love to get people to just type into the chat. Where are you dialing in from today? Always really interesting to hear. We've got a really good spread, and yeah, today's session all about forecasting for profit first, not just for performance from a marketing perspective, but really trying to understand what truly drives commercial outcomes for our e-commerce business and how do we optimize and make that into a solid plan that everybody can align around. Wow, okay, we've got a few in here. We've got Rad calling in from Boston, Montreal, New York, Galway. Always good to see a bit of Irish in there. Cincinnati, even Spain as well. David, good to see you from Vulcan. Hello, Stephen, dialing in from Dublin, New York City. Very good. We've got a really wide breadth here today, which is amazing. Great to see so many e-com brands, agencies from literally all over the world dialing in here today. And I can promise we've a really good session ahead. Anthony Kerrigan dialing in from Florida. I hope the weather is a little bit better than it is here in Dublin. Really good, really widespread there. Okay, so first and foremost, I suppose we're going to talk about why profit is the North Star. It might sound completely obvious, but let's just kind of, I suppose, start with the end in mind. For many e-commerce businesses, we're ultimately gearing ourselves up towards an exit at some point in the future. And just for context, we've obviously seen a ton of brands go through Store Hero, go through the whole exit phase, and it's a really exciting phase. One thing I suppose to keep in mind is ballpark numbers for exits. Just first and foremost, if you're trying to sell an e-commerce business, you will be sold on a multiple of your net profit figure. Okay, you won't be sold on a multiple of your top line revenue figure. Investors are looking for cash flow positive businesses, and bottom line profitability is what they're going to value you on. Depending on your business, you're looking at about a 3 to an 8x, depending on how exciting the business is. For businesses in the 3, maybe they're profitable but not necessarily growing, may not necessarily have huge growth potential, they may have tapped out international markets. For businesses at the other end, where they may be getting to the 7, 8, even 9 figure, I've seen 1 or 2 brands this year, they're businesses where they're not just seeing really high revenue growth, but also high profitability growth. They've got their unit economics down to a T, CAC to LTV is looking good, there's decent subscriber bases there, and just generally quite cash flowing, profitable businesses first and foremost. And that's definitely not an accident. It's very much planned, and it's planned from day one, and it's a lot of the stuff that we're actually going to dig into here today. If profitability is what determines your value and you're optimizing or trying to build towards a commercial outcome or an exit in the future, it's definitely worth making sure that when we're trying to build out a plan for the year, that is top of mind, that there is no ambiguity, there is no siloed behaviors that go on within businesses typically between marketing and finance. They're usually the 2 silos. Having everybody aligned under a shared commercial objective is really important for everybody. Just make sure that we know what we're doing, we know we're on track, and more importantly, knowing when we're off track, we may need to keep course correct. So just before that, we're going to jump in and have a quick kind of scan, I suppose, at last year. So how was last year? I'm just curious, even throw it into the chat. How did everyone find 2025 as a year from an e-commerce perspective? I can see there's plenty of brands in here, but also plenty of agencies. I can see Target in there. I can see Vulcan and a few more. Be just interesting to get a bit of a general sentiment as to how 2025 performance went. For me, what was interesting, I suppose, looking at we have about 650 e-commerce businesses using Store Hero now at this point, was there was a really mixed bag, to be completely honest with you. Obviously we were all in this industry a while. COVID was amazing. CPMs on the floor, ROAS through the roof. The era of kind of cheap Facebook money, I suppose, is gone, and it has got a little bit trickier. There's no doubt about it. We definitely saw a mixed bag last year. It wasn't top line growth, bottom line growth for everyone. There certainly was loads of brands that still absolutely smashed it, but there was plenty of brands that didn't, and that's okay as well. For both sets of brands, it's equally important, probably more so if you didn't have your best year, to make sure that when we're going into 2026 that we're not losing money. We're not spending frivolously. We have a plan, we have a commercial objective when we're spending our money. If you think about it, for most e-commerce brands, and not all, but for a lot of them even that we see in Store Hero, often the heaviest line out of the P&L is now your marketing budget. So you're in a situation where whoever is responsible for deploying that capital, whether it's yourself as the founder, whether it's your agency, whether it's your internal marketing manager, they are the largest investor in the business in a lot of cases, and in no other industry would the largest capital allocator for an e-commerce, for a business, not be held to account from a commercial objective each week. And what I mean by that is, we shouldn't be spending money, heavy amounts of money into Facebook and Google, and then KPIing ourselves on what those platforms tell us we did. Hold it back, going back to first principles. Did we spend more money last week? How much did we spend? Did we make not just more top line revenue? That's not hard as an e-commerce business. You can just plow money into the Facebook machine or the Google machine. The art and the science is making sure that as we're pushing more budget into Facebook and Google, that money and that extra investment for us is profitable first and foremost. Obviously, very tough year, and like you can see, David, you've mentioned it there. Certainly, some political decisions massively impacted performance. No surprise there. The US tariffs, we saw it big when it came back in April. Loads and loads of brands, particularly like we have a lot of Australian brands on the platform, and even a lot of UK and EU-based businesses that were selling into the US for quite some time. And all of a sudden, not only are things expensive, it's really unpredictable as to what's happening. Are they going to stay? Are they not going to stay? What's happening? And certainly a spanner in the works, for want of a better word, last year. So really interesting year. On top of that, no surprise again, just inflation hitting everything from not just Facebook ad cost and Google ad cost, but everything else from a bottom line perspective. Operating expense perspective. Fuel definitely going up, staff costs going up across the race, commercial rents for businesses all over the world all increasing as well, and every single dollar or pound or euro that we add to our operating expenses means that marketing dollars that we have just needs to work more and more expensive. I can see, Neil, you've called out we finished strong, but the summer was slow. Baker, you said it was expensive, and Jim, you said it was underwhelming as well. It might be nice to hear, there is other people that felt that as well. You see these headlines in all the magazines, the newspapers, even on LinkedIn, that everybody's smashing it. They're not. There's plenty of people like you guys that are kind of trying to figure it out, may not necessarily had the best year, but hopefully today, as we kind of get into the forecast, we're going to kind of pick apart how to create a plan that aligns not just with the growth goals that we have from a top line, but most importantly from a bottom line perspective. And again, I've said it already, but I suppose the old playbook of just optimizing towards ROAS, CPMs is out the window. And the really important things for teams to align on now is understanding what is that primary North Star, almost like the apex of the decision-making tree that we have. At the very top, it needs to be that incremental contribution margin. For anybody who's not familiar with that term, profitability after marketing spend. That is your North Star. Everything else flows downstream from that. Once we figure out, did we spend more money? Did we generate more profit? Then we need to figure out, okay, where do those sales come from? Where are they profitable? What types of customers are we acquiring? What type of GP do we have? Are we over discounting? Are we giving out too many returns? We'll dig into all that stuff in a few minutes as well. Okay, so what most people get wrong with forecasting, and I suppose this is where it usually goes wrong, is that for a lot of brands we see, before they come into us, the forecast that has been built for the year is, it's based off marketing numbers. Call a spade a spade. It's based off numbers from Facebook, numbers from Google, numbers from GA4. There's double attribution happening. COGS aren't being taken into account. Discounts that we run aren't necessarily taken into account. If you run a business in fashion, for instance, what's your return rate? Are you double handling with your 3PL? There's loads of these what I call little paper cuts that go into fulfilling every e-commerce order. You obviously have your 50 or 100 euro order that you get. The VAT man is taking 23% of that if you're in Ireland straight away, 20% if you're in the UK. You obviously have your product, but that's not it. It's not just your product. If you're offering a 20% discount, that's gone. Then you have your 3PL, you have your returns. If you get that back, are the 3PL going to charge you to double handle it? Are you using a buy now, pay later solution? So your transaction fees are that bit more expensive as well. They all just chop away at the margin. And every time we make an extra chop, whether it's a discount or an expensive 3PL or a buy now, pay later solution, what does that mean? That just means that your marketing needs to work that bit harder for every single paper cut that you put in. And it just means that, marketing dollars need to work a hell of a lot harder to optimize and to achieve, I suppose, the same results. So, okay, common mistakes that we see. Yes, they're built off marketing, forecasts are built off marketing metrics. There's too much time spent debating attribution windows. First click, last click attribution, this platform said that platform said this. You can lose yourself in the micro detail without necessarily understanding the overarching unit economics of the business, first and foremost. And that's just one huge change that we've seen, industry-wide, definitely in the last kind of 12 to 18 months, is that brands are getting a little bit more skeptical of what these platforms are telling them, and they're stripping it back to first principles, understanding what's my core break-even point, where can we be profitable, what does my CAC to LTV look like, what does a CAC payback window look like. Maybe some of this is jargon going over people's heads. I will send a kind of a recap out with some really, really good blogs that we've written around unit economics, CAC payback windows, all that kind of stuff. But really, really important stuff to kind of brush up on, and a really good start to the year to kind of get up to speed in it if it's not something that you're, immediately understanding there. And again, the main decision that we're trying to make each week is the decisions that we're making driving or destroying profit? And it sounds really, really basic, but nail the basics and you'll nail the business. So what are we going to cover today? So we're going to first of all build out in Store Hero how to build a profit-led forecast that reflects not just your goals but your commercial reality. So instead of a marketing-based forecast, we're going to ground it in commercial reality first and foremost, and instead of picking a marketing budget, we're going to work backwards from our sales, our margins, our fixed costs that we have, and most importantly our profit bill, or what we kind of call our profit objective, treating that profit that you need as an operator almost as a cost that we need to pay ourselves. And once we have those four core things, we're going to work backwards to figure out our marketing spend and the efficiency rate that we need to spend it on. Before I dive in, is there any questions that anyone has in anything I just went through, or anything you'd like me to kind of recap there? Again, some other bits we're going to run through is going to be around kind of how and when to increase budgets, how to slow velocity, and most importantly, when to know and how to know if you're overspending, and when to know, probably more importantly, when are you underspending, or when is there actually room to push more into these machines, into Facebook and Google, because the platforms are, very, very good at telling you that there's always more room. Okay, no questions just yet. So how do we get our gross margin right? Really, really good question, Jim. Will you cover forecasting and seasonality? Yes. Okay, so just on the gross margin piece, I might actually just dive in very, very quickly. So I kind of touched on it very, very briefly there, but the gross margin is probably one of the things I see brands get wrong the most. And it sounds like a really basic thing. Well, we have a product, we buy it for X, we sell it for Y. The spread there is what our gross margin is. It's not, unfortunately. And even going back to a situation, we actually had a brand in the UK last year, and unfortunately it was a little bit too late. They came to us just about a month before things kind of wrapped up for them, unfortunately. But the issue they had was they actually built, in fairness to them, it was a commercially grounded forecast for the year. And the agency that they had smashed it out of the park, actually nailed the plan. The issue with the whole budget was that the gross margin percentage that the brand had given the agency really hadn't taken into account that the gross margin isn't just product. And that's such an important piece. We were working with a brand recently enough, and they actually have 82% product margin, but when you took out all the returns they have, the 3PL, the free shipping, the discounts, etc., the gross margin they were actually working with was 42%. So, think about that, 82% product margin, 42% gross margin when you give it out to the customer. If that brand had built a forecast based on an 82% product margin, what was the forecast going to tell them? It was going to tell them they had absolutely bucket loads of money to go and spend on Facebook and Google when they actually didn't really, and unfortunately that's what happened for them. So we will get into gross margin. It's a really, really important piece. Ultimately, Store Hero will take into account not just your products, your product costs from Shopify, from WooCommerce, Magento, or BigCommerce, wherever you're operating from, but it will take into account all of your shipping costs. It will pull in all of your core 3PLs. We're pulling in all of the transaction fees directly from source as well, and also any of your return values and the return costs, whether you have a return cost for your 3PL or however that works internally for yourself. So yes, all of that is included in the platform, but we can kind of get into it in a few minutes. Will you cover forecasting and seasonality? Yes, absolutely, John. That's a really, really important one for us as well, just making sure that we can't build a forecast and say we're going to hit 5-10 million this year and just divide that by 12. As everybody on this call knows, ecom doesn't work like that. There is quite a it's almost like a pressure cooker at the end of the year. We have the last 6-8 weeks of the year are highly intense seasons for e-commerce brands as we kind of get into that Black Friday, Cyber Monday period. There's a lot of the year happens in the last 6 to 8 weeks of the year. So for that reason, seasonality is absolutely critically important. Okay, cool. If there's no more questions, I'm going to go ahead and open up our forecast. So right now I am looking at the main Store Hero dashboard. We're looking at the demo store and they are way over their free trial, but we'll have to have a word with them after this. So first and foremost, what we are looking at here is our spend advisor. So we can see our net sales, our spend, our overarching efficiency, MER. For anyone who's not familiar with MER, it's your business level ROAS. So irrespective of what the platforms are telling you, what's your net sales from Shopify divided by your total marketing spend, overarching MER, marketing efficiency rate. And the last one there is your contribution margin. So I've talked about that a couple of times. That is your profitability after your COGS and after your marketing spend. So instead of listening to what Facebook and Google are saying, we want to understand, okay, we dialed up the ad spend last week by 10, 20%. Less about how did it impact our top line revenue, because again, you can spend to your heart's content and drive top line revenue. The art is in making sure that when we're spending it, that contribution margin, that profit after that marketing spend increase, that's going north, and really using that as, I suppose, the prism which everything else flows down from. Really, really important piece. So that's not what we're going to go through just here, but I just wanted to kind of call that out first and foremost, just in case anybody wasn't familiar with those figures immediately. So I'm going to drop down to these little settings here, and we're going to drop into the goals, and I'm just going to go ahead and create a new forecast from scratch. Okay, so really, really important. Again, what we're trying to do here is figure out, okay, based on what we need and want to do as a business, what can we afford from a marketing perspective? Is it logistical? Is it efficient? Is it realistic? And how do we kind of make that out for the year ahead? Okay, so first and foremost, you can alter the starting month, but for everybody on this call, you're probably going to be starting this in January 2026. I'll explain why that's important in a few minutes. First and foremost, I need you to figure out, okay, what is your target revenue for the year, net revenue now. If you're operating in Ireland or the UK, strip out your VAT, that's the government's money. So what is your net sales target for the year ahead? So that's first and foremost, pop that in there. Then you want to understand what is your core COGS. We talked about the kind of, the fully loaded gross margin, not just the product, but all those little paper cuts that go with it. Your COGS are the inverse of that. So we can see here, enter the percentage of sales that you need to set aside for cover your variable costs, e.g. product, shipping, fulfillment, transaction fees, etc., etc. This part is the part I see a lot of brands get wrong in. The beauty is though, once you're onboarded in here, this just automatically populates based on the previous 12 months of data. Yes, if you're optimizing your supply chain or you're bringing in new products, you can just override it very, very quickly. But as a default, that isn't going to change massively for every e-com brand. So just first and foremost, that's a really hard number to calculate, just based on how complex e-com financials are. But that will be kind of calculated here for you automatically. Next part is operating expenses, OPEX, as other people refer to it. Essentially, what is the fixed cost that you need to cover as a business, such as staff costs, payroll, rent, insurance fees, software fees, whatever it's going to be. A good benchmark here is this is going to be in the kind of 10 to 20%, 12 to 18% if you're doing really, really well. Anything above that can be tricky to scale because it just puts more undue pressure, as I'll show in a few seconds, on your marketing spend to outperform your really, really high fixed cost base that you have. I'll explain why we need that figure here and why it determines your marketing budget in a quick second. Last piece is our target net profit. So I mentioned just at the start of the webinar, or start of the workshop here, we're going to treat profit here as a bill. And I think, there's a great book, everybody should read it, Mike Michalowicz, called Profit First. And I suppose it's drawn from the principles of that book. We are running a business not just to drive top line revenue, it needs to be commercially interesting, commercially viable for us as a founder, as an operator, as a business owner. So when we're thinking about how do we build a forecast, we need to model out what our slice of the pie needs to be day one. Or if you're an agency owner, asking this question directly to your client is puts you in such a position of power and such a, it really, the client knows that you have their best interest at heart. Because if you are trying to figure out a marketing budget for a client, and you've no consideration or understanding, maybe they won't share it with you, of what their fixed cost base is or how much profit that they need to hit to make themselves happier, to hit the targets or the goals that they want. It's very, very difficult for you to figure out what a marketing budget is because, if you have a brand that's okay with losing, 20% net profit, or a brand that needs to make 20% net profit, without that context, it's really, really difficult to figure out what our target marketing spend can be. Okay, so just to recap on that, we have 4 things now, and these are all 4 pieces of information that should be true. Everybody should understand what they are. We've got our sales target. First and foremost, every brand should know that going into 2026. What are we hoping for? Store Hero knows your COGS, so we have it in here at 41%. We then have our fixed operating costs, the cost that we need to cover as a business, as at 195k. And then we also have our target net profit figure, a target net profit bill, call it, of 195k as well. Now, you'll notice one thing I have not asked you about is the marketing budget on which you need to spend in order to make this all happen. All these numbers look great on a forecast and a spreadsheet, but we do need the gas, the juice, the ad spend in order to go and hit those figures, and how do we even calculate backwards from that? So if we imagine our business as a pie, okay, the 1.3 million is the full pie, 100%. So it's broken down into 4 key quadrants, 4-quarter accounting without getting too nerdy about it. Here we have our COGS, so 41%, $500,000. This is the cost of us to get the product out the door. All of our shipping is in there, our 3PL information, our transaction fees, any return costs, they're all in that little yellow bit. Red part here is the fixed operating expenses that the business needs to cover in order to in order to keep the lights on for the year, keep everybody employed, keep the software running, keep your insurance, your commercial rates, all that kind of thing in check. And then the last piece there, before I get to the important part, is the profitability goal or the bill or the objective of the business for the year ahead. So we have that in there. The blue part now is our marketing budget. So we've basically reverse engineered from 4 things that we know to be true. We know our sales, we know our COGS margin, we know our fixed cost base, and we know our profit objective. The last piece of the pie is what's left over. So we've just reverse engineered from 4 figures that every business should know to be true in order to figure out what that spend can be. Right? So let's just say down here, based on the metrics that you've popped in above, you can afford to spend 375k as long as you maintain an MER of 3.47. So your MER, again, just to kind of set the scene again, your MER is your business level ROAS. So net sales divided by spend. So essentially, if we multiplied 375k by 3.47, we're going to land back at our 1.3 million. That means we're going to cover our COGS, we're going to cover our fixed costs, and most importantly, we're going to work backwards to figure out what our net profit, to hit that kind of net profit goal. And what it will also tell you down below is what you did last year, right? So it's going to say, basically, last year you achieved an MER of 7.53. So do you know what? Based on past performance, seems like a reasonable goal to hit. That sliding scale at the bottom, like let's just say, for instance, we have taken on a new office and loads of new warehouse space. Okay, now our fixed costs have gone up, and the 375k that we could spend is now down to 269, and I need to be a lot more efficient with my spend. And based on last year's performance, maybe that's not going to be achievable. What's changed there, and what hasn't changed? We've just added in our fixed costs. Marketing spend is adjusted. Why has it adjusted? Because I haven't actually changed my top line figure or my profitability figure. We still need to hit the top and bottom line figures, but because I have loads more fixed costs in there, if those 2 numbers need to stay the same, well then my marketing, I need to spend less, and if I'm spending less, that needs to be a lot more efficient. So again, really, really important, and it's just an interesting way to kind of look at a business. One piece we're starting to focus on a hell of a lot more with, one piece that's really, really interesting to focus on for brands is this piece here. And it may sound boring, COGS are COGS, we can't influence that. You absolutely can. And a couple of reasons how and why you could do it. Your COGS are essentially the reverse of your gross profit margin. So thinking about, inflation, obviously, huge thing over the last couple of years. Have we increased our prices in line with inflation? Maybe you have, maybe you haven't. If you increase your prices, your GP is up and your COGS are down. Are you discounting too much? Maybe a strategy for this year, if we're trying to improve our COGS or our gross margin, is maybe hold off on less discounting. Can we lean more into average order value upsells to drive more revenue and maybe kind of subsidize some of the free shipping that we could be giving out? Even on that, are we giving out too much free shipping? What does our returns policy look like? Are we giving out free returns and free shipping, and we have a high return rate on all those kind of returns coming back, and we're getting double charged from our 3PL? This is a real area of opportunity, I would say, for a lot of e-commerce brands. And I'm just going to show you how some really, really small changes at the COGS level can have an impact and just improve your odds of hitting your target. Again, I'm not going to go ahead and change anything else here. We're going for 1.3 million. We're going for 1.95k of bottom line profitability. Let's just say, we realize we're really we're being way too generous with our free shipping threshold. We're giving out free returns, we're discounting the hell out of it. All of these, I call them almost micro conversion tactics, which do improve conversion rate, but at what cost? They're all a cost to the business. Every conversion tactic that erodes margin that we put in means that those marketing dollars, euros, pounds need to work a lot harder and be more efficient to offset the paper cut that you've put in the first place. Let's just say we were going to be brutal with it next year, and we said, not even be too brutal, maybe that's a bit harsh. Let's just say we could get from 41% down to 38%. Right, so right now, before I make that change, we currently can spend 375k at an MER of 3.47. So watch what happens when I change my COGS from 41 to 38. Okay, wow, straight away, we've added, the bones of 45k of additional marketing spend, and we've dropped our MER by about 20% there as well. All we've done there is a slight change in our COGS. Based on what we see in Store Hero, there is so much opportunity with all of the brands we see to fix that level. Instead of trying to get down to the absolute root of figuring out the attribution of every single order, look at your offer structure. Are we being too generous with the discounts up front? Are we just being too generous overall? If we can be a little bit more disciplined and pull back on some of those, conversion tactics that we're putting in place, can we preserve some margin? And what will the impact be on our allowable marketing budget, which is down here, in order to go and hit the exact same target? Like right now, we've made a small change there, right? We've dropped our COGS from 41% to 38%. I've now just freed up, call it 50 grand of extra budget for me to go and hit the exact same target from a top line perspective and a bottom line perspective. So really, really important piece to kind of dive in and understand there. I'm just going to jump back to the chat here because there's a couple of different questions in since I last looked at it here. John, what's a good way to estimate your sales? Really, really good question. I would be looking at kind of what you did last year. How were you ramping spend throughout the year? How did the efficiency match, increases or decreases in ad spend? But most important, I suppose, I'd be trying to understand what was the contribution margin impact of those increases or decreases. Let's just say, for instance, in July last year, you started to double down on spend and revenue went up quite considerably, as did contribution margin. Then I would say you've a really, really good shot to kind of drive it on and keep going for the next year. You've kind of proven out that increased investment is not just good for your top line, but pretty good for your bottom line too. On the flip side, if for instance you made the same decision in July and you thought or you were told that there was a big opportunity to double down and spend, but maybe you saw top line growth, but maybe you didn't see the bottom line result of it, then I'd be saying, okay, maybe we need to be a little bit more cautious here, because the increased investment, while it brought us more top line revenue, didn't necessarily drive the bottom line result that we were hoping for. And again, that's just assuming the baseline assumption there is that you are trying to grow a profitable e-commerce business in the short term. And people are listening saying, is that not completely obvious? Why is everybody not trying to do that? You may be trying to break into a new market. You may be okay with losing money in a new market for 6, 12, 18 months. That can be the case. If you've raised money, you may not necessarily be KPI'd on bottom line profitability. It could all be about top line growth. So just to kind of maybe just double down on that nuance there. David, what are the best and easiest ways to improve COGS for brands? Yeah, just a couple of the ones I went through there. Honestly, pricing is a really, really easy lever. Shipping, free shipping. A good rule of thumb that we always say is have your free shipping threshold about 20% above your average order value. If it's below that, there's definitely room to pretty easily increase that. That's generally what the benchmark is out there. Another one is just returns. Returns can be a silent killer. We have some fast fashion brands who may have 20 to 40% returns. If you're giving out free returns and you work with a 3PL, you're not just paying Facebook for that order for your customer acquisition cost. You are sending that product out sometimes for free. Then you're paying the free shipping back. The 3PL has had to send the order out and send the order back. Even before you get the product back, and assuming you can sell it again and it isn't ruined, you could be 10 or 15 quid in the hole, even excluding your Facebook cost as well. So trying to make sure that we're just not being too generous on that. But if you can start to pull back on COGS a little bit more in some of those, it's such a huge kick. I do have a couple of blogs written on the website just around 3 levers to improve gross margin expansion, and kind of really how to formulate a first offer structure on there. Definitely worth a look, but I will pop them in the email afterwards as well. Okay, next one from LS. How long would it take to improve my COGS and Store Hero identify quick wins? Yeah, absolutely, 100%. You can see them pretty quickly and easily in Store Hero, in the finance page, in the store overview. If anyone on the call is a Store Hero user and you ever want to kind of just take a bit more of a deep dive, just jump into the little chat there. If you want to have a call, any member of the team would be more than happy to jump on and do a quick personalized session to see where those opportunities are. I guarantee you there's loads, there always is. So yeah, we can definitely help see them in the system quite easily, but if you want an extra handhold to kind of pick up what those look like, just shoot us a message. We're more than happy to jump on a call. Jack, how to predict volume of new customers? Will this be directly affected by acquisition, efficiency and performance? Great question. Okay, so as you can see at the bottom here, the new customer percentage is there. So this is pulled automatically based on your last 12 months of what that is from Shopify. So what percentage of our customers last year were new customers coming through the funnel? We're using that immediately as a baseline for next year. Now, let's just say, for instance, that next year's a growth year. We're going to sacrifice bottom line profitability. We're going to drop this to, 100K. But based on that, we're going to spend a lot more money. Now, what's going to happen if we're trying to, spend more money? Ideally, that new customer percentage of our overall volume is going to increase. So we will have to make some kind of estimate. And again, more than happy to try and help anyone with that on the call. It depends. I'm not giving a great answer there, but it really depends on, I suppose, the change of what the business strategy is. Like, for instance, we had a brand there last year and they just took on money. They took on about, I think, 1.5 million. It was a brand based in the US. They'd never had that before and they were really going after it. So we had to kind of do some degradation of efficiency, messy stuff in Google Sheets to really figure out what that was going to look like for them. Obviously, their trailing 12 months new customer percentage wasn't going to be representative of the following 12 months, just based on the growth rates that they needed to hit. The vast majority of that increase was going to need to come from new customers. Okay, perfect. I'm just going to go ahead down here and I'm going to go ahead and hit next. So again, just to double click on everything that we've done before we go to the next piece, we have said we're going to hit 1.3 million. This is our COGS, that's our OPEX, our fixed cost, salaries, wages, that kind of thing. This is our profit bill, profit objective, and then we've worked backwards to figure out, okay, if all those things are true, this is our allowable marketing budget, and with this budget, we just need to make the rest happen. That's the max we can spend. If we spend this, hit that kind of efficiency rate down here, we will hit our sales target, we should hit our COGS target, we'll clear our OPEX, and most importantly, hit that profit. This is the fundamental piece. This is the foundation in which we're going to build the commercial objective for the year ahead. So next thing we need to do is go and say, how do we look at this on a weekly basis, monthly basis, daily basis, whatever it's going to be. So we're going to go down here and click next. Okay, perfect. So next we can see, what are we looking at? Our monthly targets. So the first thing you'll see here is loads of numbers. So what do they all mean? First and foremost up top, and I can't remember who it was, somebody asked a question there about seasonality. We can't just take 1.3 million and divide it by 12. That's not going to be of any use to anybody. Most businesses are Q4 heavy. So what have we done and how do we get around that? We've taken your trailing 12 months of revenue and we've divided it out. So let's just say, this brand in January, our target for the year is 1.3 million. We need to do, on average, we generally do 5.21% of our revenue in January. Therefore, I need 67K of net revenue in January, and so on and so forth. As we kind of get towards the end of the year, no surprises, Q4 is quite heavy. Those sales figures start to ramp up. We can see our marketing spends, our COGS, AOV. You can alter all these. I'll go through that in a quick second. Based on the target marketing budget that we've just created from the previous page, again, it's going to use seasonality to map out what those budgets can and need to be. Again, sometimes there will be situations where we need to spend heavier because, in July, because we're dropping a new product in August. This is quite flexible, quite dynamic, and it can change to account for those things. Out of the box, this is perfect for 90% of brands, but there is obviously edge cases as there are with everything, but the forecast can be quite dynamic and flexible to cater for those needs. Next piece there is that contribution margin. So again, we have our net sales minus our COGS all the way down to that kind of profitability after marketing spend. So this is our profit after marketing spend, but before operating expenses, of which we have 195K. So 390 minus 195 leaves us with our 195K of net profit, and it shows how that's split throughout the year in different months. But it's not just a financial forecast. There's a lot more to that, and obviously we have all of that data in Store Hero. So essentially what we've done is use the data that's in Store Hero to basically triangulate between your commercial objectives, your seasonal objectives, your profitability objectives to map out How many new customers we need to drive, how many repeat customers do I need in May, what's my customer acquisition cost, how much GP do I need from new customers, what kind of orders do I need each month. Really, really handy, because what it does is now we have a mechanism to hold every single number in here accountable at all times, and it just helps us understand and keep on track. Most importantly, keeps us on track and off track as we kind of progress throughout the year. We actually launched this quite a while ago, but it's just really, really good to do this at the start of the year. This was kind of an MVP, I suppose, that we built at this, was done on a spreadsheet last year for an 8-figure brand that we were working with in the US. They actually finished up within 2% of their net profit figure. I saw it there about 2 weeks ago, which was amazing for us because, it was an MVP product that we built in spreadsheets, and it's just so fantastic that we now have it in the platform and everybody has access to it. The beauty for them was that they just had the confidence and clarity to scale. Like, that business went from, I think, 4 million to about 10 million last year. Really, really good growth. But the important piece for them was they didn't want to just go hell for leather at spend in the chase of top line revenue goals. It needed to be profitable for them. Family run business over there. They're not externally funded, all that kind of thing, as is most e-commerce businesses. So really, really important, but it just gave them the confidence and clarity to scale and to push back. And there was times where they needed to push back throughout the year. Okay, so I kind of touched on being able to make the platform a little bit more dynamic. So let's just say, for instance, that, I don't know, let's pick a bad month here, February. Let's just say February last year, this brand ran out of stock, and actually February is usually a good month for them. So last year's seasonality, it's not really going to be it's not going to be very, very beneficial for them. So let's just say that usually is 8%. Okay, well, what's happened now? Well, we've actually allocated 103% of the sales. That's not going to work. So we're going to need to make a manual adjustment there, but we are going to need to debit it from other months. So we'll say maybe May gets back to 7, I don't know, April comes back to 9, and these are just very rudimentary examples just to show you that it can be quite dynamic, and maybe September comes back to 5. So it won't actually let us complete the forecast until this is back to 100%, just to make sure that we're not over allocating sales at different times of the year. Obviously, the forecast needs to stack up and make sense. So just a really, really important piece there. Okay, so now we have a financial forecast backed up with all of our orders per month, how many new customers we need, repeat customers, email marketing revenue, customer acquisition costs, etc., etc. So we need to go ahead next and just click finish. So now we've gone ahead, we've created our profit first forecast, we know what our marketing budget is, it's cognizant of all of our fixed operating expenses, it has all of our COGS, our margins baked in here. Everything that we would need to run an e-commerce business is baked in here. Now, what you'll quickly see is, and why this platform is a little bit different to maybe some other tools out there, is you'll see this little piece here with the behind target or ahead of target. So instead of us just logging into platform and seeing, sales up 10% this week, marketing spend up 10%, while that's great, it doesn't necessarily tell you, are we on track or off track, based on the commercial reality that we're aiming to create this year. So we can see, this is an unfair reflection because this business has quite a good December, but we can see, sales are down 79% month on month, but we're actually only 18% behind the target. Marketing spend, we're 44% down on last month, so we actually haven't spent 83% of the budget. That being said, efficiency is way down compared to December, but we're way more efficient than we need to be. So we're way under budget, but we're way more efficient than we need to be. Profitability is down, our profit after marketing spend is down by 81%, but we're actually still 46% ahead of the budget. So really, really important. I log in here very, very quickly, 18% behind from a sales perspective, 83% under our marketing budget, way more efficient than we need to be, and we're actually still over our profit objective. So there's a really, really simple fix and an easy fix if we wanted to double down and fix the sales figure here. We would just spend more money. We're way under budget and we're way more efficient than we need to be. But this is not beholden to anything that Facebook and Google are telling us. This efficiency number is purely net sales divided by spend. So all we're taking from those platforms is what we have actually gone ahead and spent in them. Next piece that we can run through very, very quickly is in here. We can start to actually hold every single number in here accountable around that profitability objective. So let's just take, net sales as an example, or even new total customers. So we have had 597 new total customers this month. Last month in December, we had 3,186. So it's down 81%. The target that we actually should have hit this month was 741. So we are 19% behind target. That's really, 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 really important information for brands to have. Obviously, I'm comparing January to December. We can obviously flick this over and compare year over year, where January is not always their best month, but we can compare like for like just as easily as well. Really, really important for us to understand, okay, how are we performing now versus target? How are we performing versus previous year? But it just kind of is a no-nonsense approach. Instead of thinking everything is a conversion rate issue or a retention issue or a gross margin issue, we can now really cut to the mustard and see, okay, based on the plan that we'd already set, that aligns with our goals for the year, what are actually the key numbers that we need to be working on? And we can just be a lot more surgical, I suppose, in terms of our approach and our strategy sessions, because there's so much data in ecom, which is fantastic, but it's also its Achilles heel in that it can be difficult sometimes to ascertain what we need to dig into, where the problems actually are, where the real opportunities are, if we don't have a shared plan to work towards from the ecom team, the agency, the finance team, and the founder. Okay, perfect. Just before I'm going to dive into one or two other bits there, Sharon, Sebastian, you had a question. Any AI tools for getting customer feedback at scale other than surveys? I was going to suggest post-purchase surveys, but maybe that's not the best answer there. I don't actually have any straight off hand, Sharon, but what I will do is I'll get one of the members of the team to do a quick scan after the call. Or if anybody else in the session actually here has any suggestions for Sharon, that would be great. But if you don't, what we will do is you follow up with you on an email directly after the call later on this evening. Okay, now next piece. So that's great. We have decided, we've set our target. We know what we're optimizing towards. We can see where we're on track and off track. But let's just say we're behind target on certain numbers. How do we improve them, or how do we even just get insights into them? If we scroll down here, what we have done quite recently is introduce this insights layer. Now, a lot of you Store Hero users who are already using the platform and who are on this webinar are probably familiar with this. Maybe you're not, but if you are, great time to be tuning in. Basically, what we're going to show right here is what's working and what could be improved. Now, why do we build this? So we built this because there's loads of data in here. Now, first and foremost, we now have a mechanism to hold every single number accountable. But let's just say, for instance, we can see here our new customer sales, our new customers overall, we're way behind target. Your next job is going to be to figure out, well, why did that happen? We had set this target, we didn't actually hit it. Why did that happen? And most importantly, show me the data to back it up, and what am I going to do about it? Ultimately, for us, the North Star at Store Hero is actually to have probably people spend less time in Store Hero, because if you can log in and actually just see what happened positively and more importantly negatively sometimes, and figure out what the solution is, we just want you going and actually actioning those things as quickly as possible. So basically, this is a different take on AI than a lot of people are seeing. We haven't given you a chatbot, at least yet, to ask questions on. And I suppose the reason for that is the value that anybody gets from an AI chatbot, the real value is going to be derived from your ability to prompt engineer the chatbot in a way that you will get the desired result that you want. So we've kind of, again, reverse engineered that. And what do I mean by that? What we have done is, by building the forecast, by having a mechanism to hold every single number accountable around our seasonality objectives and around our profitability objectives, I now know what question you should be asking. I know that your new customers are down. So basically, we've done some pretty detailed prompt engineering in the back end to figure out, okay, Mary, who's running this apparel business, she's missed her new customer sales, her new customer numbers by 30%. We've done the heavy lifting in the back end to write a pretty detailed prompt to figure out what questions should she be asking in order to get the best result for her to change that metric and make it better. So let's just say sales from new customers, 30% behind target. We can see this was affected by a 5% increase in new customers, but also a 4% decrease in new customer AOV. What's the number? Where was it versus December? Where was it versus last year? And most importantly, where is it versus the target? We can obviously hover over here and see year-over-year comparison. But then we're getting into likely causes. So marketing performance for new customer sales is below target because spend is significantly down. And again, no surprise there. We saw the spend advisor were 83% below target. Efficiency improved but did not offset the lower budget. So this is just a spend issue. We didn't spend enough. New customer sales rose slightly by 1% to X, but remain below last period. Marketing spend fell by 42% to X, indicating substantial underspend. Acquisition, MER, for anyone who's not familiar with that term, essentially our new customer revenue divided by marketing spend rose really, really strongly to 74%. But it's no surprise we completely pulled the budget, showing much better efficiency. Again, are we chasing efficiency or are we chasing profitability? New customer AOV decreased by 4% to 35.15, mildly reducing the order quality. Next piece here is the supporting data. Now, it's all well and good telling you the likely causes, but you need to have a bit of proof to back it up. So we can see here a number of different metrics that will be related to driving new customers to your e-com store. So everything from new customer sales, gross profits per new customer, spend by channel, ROAS by channel, new customer AOV, overarching marketing spend, customer acquisition costs, where we are versus the target if we've set it, and then most importantly again relative to where we were at the previous period. And the holy grail then down the bottom is suggested next steps. So we have missed the target by 30%. We've gone through the causes, we've showed you the data. Most importantly, what am I going to do about it? So it triangulates between what we should have done this week, this month, this day. And by the way, that forecast will prorate based on the time period that we've looked at. We're obviously only on the 15th of January, so that forecast is split in half for halfway through the month. We're triangulating between what you should have done versus what happened, and then sucking in all the data that's currently in Store Hero to give you the most personalized suggestions in terms of what to do from a campaign perspective, and that's just this one. So dialing up these campaigns, pulling back that channel, monitoring this AOV, depending on the insight that you want, whether it's marketing performance, profit from new customer orders, repeat customer orders. Like the repeat customer orders start to get more detailed into some of your Klaviyo revenue. Your profitability insights will start to pull in discounts information, shipping information, product bundles information, all that kind of good stuff. Like optimize your win-back flow to recover the €488 shortfall, begin enhancing these creatives for these campaigns, all that kind of thing. So it's very much personalized around the number that we've hit or that we've missed. So loads and loads and loads of really, really good insight in there. Actually, we've only launched that a couple of months ago, but the feedback to date has honestly been phenomenal. Now, I just want to pause and see if anybody has any follow-on questions. Webinars are kind of a funny setup in that I'm talking to all of you, but nobody can speak back to me. So please jump in with any questions. I did talk very, very fast. I always do. But please jump in with any questions, and I would love to kind of just get to the nuts and bolts and see if I can provide any more value. And just while those questions are coming in there, we can see, as we're moving through the platform, we can see where we're on track or off track for different numbers. We've also released a new agent builder last week. So if we wanted to jump in here, we can see, okay, send me a contribution margin agent report. I want it by email, I want it by Slack. What kind of time period do I want it over? When do I want it to come to me? And versus last period or last year. Once that's jumped in, I click save. Now I'm going to get a Slack report sent to my personal DM in Slack every single day, or whatever kind of time period, every day, around a customer contribution margin. And again, some of the results from that, we actually only released it last week, are really, really positive. And we're going to be doing a hell of a lot more on that topic, over the next kind of 12 to 18 months as well. Okay, so one coming in there from Carly Saunders. How do I determine a reasonable CAC limit? My repeat purchase rates are good, but I'm worried about losing too much profit on first order. So again, your reasonable CAC limit is going to be, really good question by the way. It's going to be determined by the allowable marketing budget that we had on the first order, on the first page where we kind of built the forecast. It's going to be determined by the marketing budget that came to the end. And then obviously very much heavily influenced by that new customer percentage that's in there. In terms of what's allowable and what's not allowable, one metric, not to get too nerdy about it, that I always find that's really, really interesting here is your new customer contribution margin. In English terms, what does that mean? New customer contribution margin is essentially the new customer gross profit. So we can see here, for instance, these guys, typically they generate €25.60 for every new customer. On average, it's costing them €30 to acquire those customers. So on average, they're losing $4.54 per new customer when they acquire them. Now, this business probably has a good lifetime value where that's actually part of the strategy. They don't want or need to be profitable on that first purchase, but in doing so, they're building up that new customer base. They're confident of the LTV coming in and will make that money up on the back end. Sometimes, there can be situations where being first order profitable, it's great by the way, and most businesses probably should be optimizing towards that. But if you're a business that maybe relies heavily on repeat customers or subscribers, often there's an opportunity cost to being first order profitable. And what do I mean by that? If for instance you can pay €20 a month or £20 a month to acquire X amount of customers and be first order profitable, maybe a break even point, if you're confident that, okay, we get €20 of margin on that first purchase, but our customers typically shop 4 times a year and that gross margin goes from €20 to €80 after 12 months. Well, what does that tell you? If we could spend €30 to acquire customers how many more new customers could we actually get? And even though we'd sacrifice being maybe first month profitable, if we were profitable by the second month and we could increase our volume of new customers by 50%, given the LTV that we have, we would have a much bigger and a much better business in the long run. Park jumped in there. How is LTV calculated? Again, super question. I'm just going to jump through our kind of cohort analysis here very, very quickly. LTV analysis. So how is LTV calculated? I'll tell you how it's not calculated, first of all. It's not your average order value multiplied by your purchase frequency, which is one I see online all the time. The reason it's not that is, like, what is value? For lifetime is easy, you know, time span in which we measure the purchase behavior. The value piece is one I see brands get wrong all the time. Like, what is the value? The value is not necessarily the revenue that the customer delivers, because the revenue is not your margin. So the value is the gross profit margin of that customer on the first purchase. So again, just to call it out for these guys, they acquired a customer for €11. They had €24 of margin on first order, not revenue. If I change this to look at revenue, we can obviously see that as well. Just give it a quick second. So the revenue that this customer is going to generate, I think it's about €41 of revenue. But again, they have VAT to pay, they have product, they have packing, shipping, discounts, etc., etc. So I always like to look at LTV purely on a gross profit basis first and foremost, because it does give me a real indication as to what my customer acquisition cost is, and most importantly, what is my actual margin of that customer on that first purchase. Okay, perfect. Before we wrap, guys, is there any other questions anyone has here? Just before I jump. One other exciting piece of news that we actually launched last week was we actually went live in the Shopify App Store. So anybody who's, you know, semi-curious about Store Hero, if you want to jump on a call, obviously just send us an email, more than happy to do it. But if you want to try out Store Hero on a free trial, you can download it directly in the App Store. I'll just actually drop the link directly into the chat here. You can download it, you'll be set up and onboarded yourself within a few minutes, and really, really easy to get that set up and running. So I don't think I'll remember all of this, Mike. Yes, what I will do, Mike, is there will be a recording of this going out straight after the call. As I said, there is a chatbot directly on the website. Feel free to message any of us. We're more than happy to jump on a call this evening or tomorrow. And yes, you can jump on at any time. Yes, guys, there is a free trial on there as well. So I've just actually popped in the link to the Shopify App Store on there. So feel free to jump on there. You won't get charged. It's a free trial. And we're more than happy to do an onboarding call, a free consult to help you get the most value out of the platform. Typically what we'll see is during the onboarding call, you will have a hell of a lot of value that you'll be able to take from the platform, whether you go ahead with us or not. I do think it'll be a learning experience and something that you'll be able to get a lot of value from to kind of drive forward for the year ahead. Okay, perfect, guys. Listen, if there's no more questions, we'll leave it there for today. As I said, you will get a follow-up email from us with a recording of the call. And if anyone has any questions at all, please reach out to us by email or drop it into the kind of chat bot there on the main website or within the app. And we're more than happy to do a consult call for any of our existing customers or for any new people joining in today. You know, more than happy to schedule a demo call and set you guys up with a free trial. No worries, guys. Thanks very much. Perfect. Thanks, guys. See ya.